Hello and welcome to a brand new episode of ET Markets PMS Talk, a show where we discuss about the opportunities as well as challenges faced by the fund managers in the popular space of ultra HNI investing. Well, my name is Shatajanand and today we have with us a very special guest, Manoj Bahety, the CFA, founder at Carnelian Capital Advisors LLP. Welcome to the show, Manoj.
Thank you. Thank you, Satish. And it's indeed my honor to be part of this show.
Thank you so much for your time, Manoj. Now, let me come first to the point that you're managing more than 1,900 odd crores in AUM. Tell us a little bit about the performance of the PMS schemes in FY23.
So FY23 definitely on macro side or overall market side, it was a bit challenging year. But fortunately, almost all our schemes, so we are running around three major flagship schemes. One is our maiden scheme, which is a Carnelian Capital Compounder strategy, which we are having both under PMS and AIF. Second one is Shift strategy. Shift also recently we have started the replica of Shift under AIF also. Till now we were running under PMS format. And the third one is YNG. So all these three strategies, in terms of absolute returns, definitely it was not as good as it was. But in terms of alpha, if I compare with the benchmark, so coming to our Carnelian Capital Compounder Fund, which is under AIF, it has delivered around 0.3% kind of return vis-a-vis benchmark of negative 2%. Okay. So we have delivered an alpha of around 2.3%. That is on the AIF part. Same thing if I look at PMS. In fact, on PMS, it is a negative absolute return to the investors. It's a negative 1%. So is benchmark negative of 2%. So here also, though we are not happy with the negative absolute return, because ultimately what matters to the investor is the absolute return. But I think in terms of alpha, we have done reasonably better job. Now let me just come to our other strategy, which is a Carnelian Shift strategy. And Shift, if you recall, this strategy we have launched at a time when entire world was in the amidst pessimism.
It was launched in 2020, if I'm not wrong.
Absolutely. Yes. So it was in October 2020. Yes. And that was the time when we have started communicating to the investors that this crisis over medium term will do definitely good, particularly in two segments. One is manufacturing in India and second is the technology. And we have also highlighted that how this pandemic or this crisis is going to accelerate the shift towards manufacturing in India and towards faster adoption to the technology, digital, cloud, artificial intelligence. And that was the time when we have launched this strategy. So this strategy, which was predominantly into manufacturing, and also some portion of the investment is into IT sector. This strategy has delivered over last 12 months 2.5% of positive return vis-a-vis benchmark of 2.25% negative return. So this strategy has delivered a decent alpha of 4.7%. And if I come to this AIF portion, which we have launched in April last year, so that has given us 7.6% of absolute positive return to the investors vis-a-vis benchmark of around negative 4%. So there we are having around 12% kind of alpha. So and the last one is the YNG strategy. Kshitij, if you recall, that was the strategy which we have launched around a year back. And the main reason for launching that strategy is to give solution to HNI investors who were grappling with hyperinflation. Like when we see the reported inflation, that is one number, but the real inflation number is much, much higher. Right. And the kind of return those HNIs were generating from fixed income portfolio we were damn sure that they are not going to beat the inflation, and it will be ultimately negative real return. So that was the reason we have launched a specific YNG strategy. So YNG, as the name says, it is a combination of yield and growth.
Yield and growth, yes.
So it is not only that we will pick up high dividend paying stock if the growth element is missing. Yeah. So if you can pick up, let's say, if you can curate a portfolio of 10 to 12 stocks, which can give you around 5 to 8% kind of FCF yield, which can be repaid to the investors by way of dividends. And over and above that, if the company can deliver 12 to 15% kind of earning CAGR over next 3 years, what we are talking about 16 to 17% kind of return, because eventually this earning growth will translate into the earning price into stock price appreciation of those companies. And another thing, Kshitij, I would like to add here, unlike market perception that when we talk about YNG or high dividend paying stocks, generally the perception is that whether they are creating a portfolio of PSU stocks. So in our YNG portfolio, you may find very few PSU stocks. The stocks are mainly from the private sectors, where we can capture both a better dividend yield, FCF yield, and the earning growth trajectory for those companies. And Kshitij, just 1 minute, I forgot to mention the return of this strategy. So this strategy, over last 12 months period, this has delivered around 13% kind of absolute return. So this summarizes the strategies which we are running.
I was just going through the YNG strategy as well, and the AIF, the capital compounders, and especially YNG is very unique strategy. On all grounds. If I look at if you look at how it is structured, in a way, it is giving the capital protection. I mean, it is also giving the comfort level to the investor who doesn't want to take that kind of high risk, but at the same time it is also delivering on the return part. So full marks to in devising that particular strategy. We definitely come and talk more about that strategy, but let me also come to the AIF bit now. The capital compounders AIF, now data provided by PMS Bazaar suggests that the fund is actually giving a CAGR around about 15% since 2019. So if you can help us explain the strategy and how do you pick stocks in that particular format.
So Kshitij, this capital compounder strategy, it is a completely sector agnostic strategy.
Okay.
Though we have few exclusions, like we don't invest into regulated spaces, we don't invest into commodities. Other than that, I think it is a complete flexible strategy where and the main objective of this strategy is to capture the growth opportunities within India's listed space. So that is one of the things, and various growth opportunities which we see emerging, whether it is on the BFSI space, manufacturing space, and within manufacturing, the way the import shift is happening to India, the way the export opportunities are opening up. So all those spaces we try to capture, and when we select the stocks or when we create portfolio, we follow a very, very unique approach. Like we call our portfolio, we categorize our portfolio in 3 broad categories. One is the magic category, second one is the compounder category, and third one is the opportunistic category. Correct. So around 55 to 60% of our portfolio stocks, when we select them, they are part of our magic portfolio. Let me just take a minute to explain that what do we mean by magic portfolio. Like when an investor invests into a stock, there are 2 means of returns. One is as the company grows its earning, that earning growth will ultimately get reflected into the stock price. So ideally the stock price should grow in line with the earning growth trajectory of the company. The second thing which can deliver return to the investor is the PE re-rating part. Like the same stock which earlier might be valued by the investor at X price to earning multiple, if that gets re-rated. So under magic category, we try to identify those companies where there is some change has happened, and that change is likely to deliver a PE re-rating. Let's say there is a company which has been growing at let's say 10% earning growth in the history. And that company has now a CEO change.
Okay.
The new CEO has articulated a new strategy for the company, articulating that how he wants to take this company from 10% to 20% kind of earning growth trajectory. So when you can pick up those companies where some visible catalyst change has already happened, which will lead to acceleration in the earning growth trajectory of the company. So when this acceleration in earning growth trajectory of the company happens, same company investor will start assigning a higher multiple. Right. So that is one of the things when we select the company, and there are various catalysts which we keep on watching, like whether there is a management change in the company, whether the company is entering into a new business vertical which will accelerate the growth trajectory, or there is an improvement in the balance sheet of the company, whether the leverage is coming down or the capex cycle is coming to an end. All these aspects can play a role of catalyst which can lead to the earning re-rate. So that is the way when we select the companies in our portfolio. And another thing which is there, like when we pick up the companies, one thing we are very, very clear that we are going to invest in structural growth businesses which are run by great management at fair valuation and within Carnelian risk reward framework. So that is one thing very, very clear. So I already spoke about the magic part. The second one is the compounder category, where we try to pick up the stocks which are already, I would say, established franchises, where we are not expecting a further P re-rating, but where we expect that the earning growth trajectory will continue at least for next 5-8 years. So those are the companies we try to pick up under the compounder category, that is around 30 to 40% of our portfolio. So that is the way we select the stocks. Now, talking about only returns is incomplete unless you touch the risk component.
Absolutely.
So all these stocks which we select, whether it is compounder, shape, YNG, it has to undergo through our forensic lens or forensic deep dive. In fact, we will talk about later, but whenever we select stocks, if we see even a slightest forensic issues on the governance side or the accounting side, will pass that. So that way we manage the risk, and if any business is prone to disruption risk, that also will pass. So that is the way we curate the portfolio and select the stocks.
Right. In fact, you just pointed about the framework, that is the CLEAR framework, if I'm not wrong. Then, and it's a unique CLEAR framework or a forensic framework that you have, and that is being used in every strategy. If you can help us more in, understanding the concept CLEAR that Carnelian is using for every strategy.
Yeah, sure, Kshitij. I think this is one of the things which is very, very close to my heart.
Okay.
In fact, I was doing the forensic almost for last 10-12 years. In fact, we have started this in 2008 when I was in Edelweiss, and we were first in the industry to start the forensic research, and which was keenly followed by most of the institutional investors who are investing their money in India. And at Carnelian, I think this is the thing which we continued, and this is our edge. So when we talk about forensic is nothing but connecting dots. Like when we look at the income statement of the company or balance sheet of the company or cash flows of the company, one thing which one has to ensure that all these three statements, whether they are connecting the dots with each other. Means quite often we have found that the company may be generating X amount of profit in the income statement, but that profit is not translating into any kind of asset creation in the balance sheet. Those cases are there. If those profits are not getting converted into any kind of cash flows, what kind of governance issues companies is having, what kind of related party transaction which the company is having. So when we talk about clear framework involves two-step deep dive into the company. So at Carnelian, we have built our own proprietary template where any listed company, you just put a ticker, it will pull out last 10 years of the data from publicly available filing, including notes to accounts, related party transactions, subsidiary details, all those things. and thereafter it will throw potential red flags in 4-5 minutes, which will help us to decide whether it is worthwhile to spend more time into this company or we can drop at this stage. Once we decide to take the company to further research, then there is a separate team which does an in-depth forensic analysis, and wherever we see that there are issues in terms of governance, related party, balance sheet or disclosure, transparency, we pass those issues. So each and every company in our portfolio, it has to pass through 2 steps of the forensic deep dive.
No, very nice. And in fact, that is one way in, basically filtering out stocks of if they're showing any signs of regulatory mismanagement or something like that. So yes, definitely, I think that's the right way to approach in portfolio building. I hope individual investors, who do DIY approach also, understand these concepts. And in fact, whenever they are also building a portfolio, they can also at least give importance to regulatory aspects as well. Now, coming to YNG portfolio, it's very unique and probably it is designed to capture the yield and growth across themes. So also tell us, how do you pick stocks for this portfolio? And there's a debt element or fixed income element as well in this particular space. So tell us more about that as well.
So Kshitij, let me first address your last question. There is no fixed income component in this strategy.
Okay, so
it is all equities.
All equities.
In fact, we can, but we have not. So it is all equities, and it is a very, very concentrated portfolio of 10 to 12 stocks. The reason for keeping a concentrated portfolio, like when you are picking up only 10 to 12 stocks, which are offering 5 to 8% or 5 to 10% kind of dividend yield or cash flow yield.
Right. Okay. Yes.
And those stocks which are delivering around 12 to 15% kind of earning growth trajectory. And when the stocks are offering, let's say 5 to 8% or 5 to 10% kind of dividend yield, at least one thing you have taken care is that valuation wise they are not expensive, because when you are talking 5 to 10% kind of cash flow yield, these stocks are trading at 10 times or 15 times of their free cash flow generation every year. So that is one. So that is the reason, like, you can build a very, very concentrated portfolio because these are so-called safer investments, but these are designed for the investors who can invest for next 3 to 5 years, because these stocks, though they do not have much downside, but they can remain stagnant for, let's say, 1.5 years. Your dividend will keep on coming to you, but sometimes the impact of the earning growth trajectory, it can give you a lumpy kind of returns. So to capture both dividend yield as well as the earning growth trajectory, what we expect from our investors, that at least give us that money which you are intending to invest for 3 years, so you can capture both the engines, the dividend as well as the earning growth. And as I mentioned in my initial remarks, there are various companies which are even in the private sector. Like there was a time when even IT stocks were available at 5-6% kind of dividend yields. The companies which were delivering almost like 8 to 10% kind of dollar growth. On that, if you add the rupee dollar depreciation, so that kind of stocks were also available. There were even stocks in the FMCG segment. Even today, those stocks are delivering 4-5% kind of dividend yield, as well as those stocks can deliver around 12 to 15% kind of earning growth trajectory. And this is the way we select stocks. So in YNG strategy, it will be relatively lesser volatile portfolio. And on 3 years perspective, we are like, we will assign a very high probability that this portfolio should deliver anywhere between 15 to 20% of overall return, a combination of dividend yield plus the stock price appreciation.
No, absolutely. And I'm sure, investors who are looking for that kind of, you could say, a double-digit kind of return. At the same time, keeping the risk profile in the mind, would opt for this one. But we also discussed about the Carnelian shift strategy in the beginning of our conversation. And in fact, that was launched in 2020, as we were talking about. It has given a very handsome CAGR, according to the PMS Bazaar database. And the strategy which you followed actually played out really well, because at the time when 2020 or the COVID happened, a lot of stress was on manufacturing or Make in India, and a lot of units were set up in that particular time frame. And also IT or export units also did pretty well in that particular time frame, and that's why so hats off to you for actually taking that trend or riding that trend at that particular point in time. So and yes, 3 years down the line, what makes you now so bullish on the engineering, capital goods, IT and autos? Will that continue to keep the momentum going?
So Shritaj, it is not only engineering, capital goods and auto. In fact, wherever we see that manufacturing in India has got like two tailwinds. One is that definitely there are many sectors where there can be lot which can happen merely on account of import displacement, the kind of imports which are happening into the country, and the way the government is discouraging the imports. Yes. By supporting the localized manufacturing. Like just yesterday I was there with one of the company, and there the company was mentioning that right now the way the imports are happening into the country, like there is one space where a lot of imports happens in terms of like delivery of our insulin, like when we talk about insulin pen, and the way the government is discouraging the company, like if you want to let's say part of government system, you need not import, you need to have a localized presence. So that is another, I think, one of the things. But if I look at the entire manufacturing space, this pandemic has done two things. One is it has exposed the unreliability portion of China, like the way the supply chain of those companies got disrupted during pandemic or due to zero COVID tolerance policy of China. I think world has first time realized the kind of over dependence they were having on China. So one is that there is a global shift which is happening away from China, and India definitely is a natural destination. And India as a country, we are also importing lot of things in various segments. I think there is a huge opportunity to shift that imports from manufacturing in India. So when we talk about the spaces in manufacturing, we are very, very positive on chemical API, auto and auto ancillaries, as you mentioned, chemical and engineering goods, and defense related entities. So all those entities, and if you look at the balance sheet of all these entities, most of the guys have done good amount of capex. Like any API, any chemical company you see, most of the companies have doubled their gross block in last 3 to 5 years, and even tripled. Like few of the companies have tripled, and in many cases they have their global customer which said that okay, I will give you capex advance and I will even sign a offtake agreement. So that kind of opportunities when it is coming to the company. So we are very, very positive on these spaces. Coming to IT. So on IT, definitely when we have started the fund, there was a time when our strategy has almost 40% kind of weightage towards IT. But when this global recession and all those interest rates started going up, I think we were timely in terms of getting our overall exposure IT to a lower level. But if you talk like next 3 to 5 years, we are still positive on IT. But in short term, definitely there can be headwinds because the way the global scenario is unfolding, and definitely this sector is completely dependent. And like manufacturing, you have like twin engines. One is the domestic market, and second is the exports, and there is a global shift which is happening from China to India. So unlike that, I think IT sector, if something goes wrong globally, I think this sector will definitely get impacted over short to medium term. But if I talk about next 3 to 5 years, I think the structural trend for even IT sector is intact.
Great. And Manoj, also highlight how do you pick stocks for the small and the mid cap space. We saw FY23 small and mid caps actually underperforming the benchmark indices, and now at least for the FY24 there are a lot of talks that at least some bit of growth might get hampered as well. In terms of how IMF have come across and cut down the GDP growth rate for India, although it might not percolate down to the small and mid cap stocks. But then again, there is a higher trajectory or there is some understanding that the global growth will take that hit somewhere down the line. Although India will continue to post a healthy growth rate. But because there's a dent in the global growth rate, and at least some stocks which are dependent on the exports or the raw material, will that also get impacted? I mean, so you're taking everything into the account. So how do you pick stocks, for the small and mid cap basket?
I think it is a very, very important question, Hitesh. Like whenever you invest in small and mid caps, because these are the companies which are in the early stage of their journey, right? They have not evolved as a sophisticated institution now. They are still building lot of processes, systems, technology. So when you invest in small and mid caps, I think you have to be very, very sure. First and most important thing is what is the opportunity size for this mid cap or a small cap name. Like it should not happen that a small company, if it is into overall opportunity size also small, whatever good the company does, its growth will be constrained by the opportunity size. So one thing which you have to be very, very sure that the opportunity size is good and opportunity size is good. That is one. Second is that whether that company is having some kind of niches, like whether it is either number one, number two player within its space, whether it is having some kind of proven leadership, either cost leadership or IP leadership, or a customer reliability edge vis-a-vis peers. That is again very, very important. And the most important aspect when you look at mid-cap and small cap company is who is the guy who is driving the ship. Like who, and that is very, very important. And
what is pedigree?
Absolutely management pedigree. And I was surprised, like when I was first building the portfolio under shift strategy, like there were companies with 10 to 15 years of the track record. And even though they are in the mid cap and small cap, but 10 to 15 years of excellent growth track record with the same management. And there were cases like where the same management has made balance sheet 5x, 8x, and now he is entering into the new adjacent opportunities. So this is very, very important, the guy who is driving the show. Then not only the guy who is driving the show, you also have to look at what are the cultural aspects which the company is building within the organization, because somebody has rightly said that culture builds the organization. So that is very, very important. So whenever we invest in mid-cap and small cap companies, we ensure that we don't only meet the CEOs or the top management, we go and spend time with the plant heads, with the HR heads, with the technology head, and also we try to understand what kind of freedom these guys get when they give their ideas. So these are also very, very important softer aspects which one has to see. And last but not least is what is the quality of balance sheet, what is the quality of cash flows, overall disclosure norms, governance, forensic. So there also we put lot of emphasis, because mid cap and small caps, though it can give you very good returns, but it is always easy to lose money also. In those names. So that is, I think, one thing which we are. So that is one of the things which helps us in building the mid cap and small cap portfolio.
Absolutely. Now, finally, what is your review on markets for FY24, Manoj?
So FY24, as I think we have communicated through our monthly letters also, I think FY24, we are expecting that it will be a year with lot of volatility, the way the things are shaping up globally. But I think two, three things which gives us comfort. Valuation side, which we are much, much more comfortable than what we were. And secondly, whatever issues which are happening globally, especially on the Western world, or even the geopolitical issues, like if one think the second order impact of those issues, all those issues are going to benefit India over medium to long term. Because if let's say inflation issues are there in Europe, then if manufacturing has to shift away from Europe to other destinations, I don't think it will go to China. And India becomes a very, very sweet spot. And we are seeing like number of our portfolio stocks, they have started talking that they are getting benefited on account of some shift which is happening from Europe to them. And those guys have already started talking about building up the capacity. So FY24 definitely will be a volatile year, but rather than getting scared of volatility, I would rather scout for opportunity during volatile period, because it is during volatile period when you get a structural name within your risk reward framework. So that is the way I would say it.
I think it could be a year for new beginnings as well,
Absolutely.
So as you rightly said that, many companies are looking to expand the capacity. So yeah, it could be another year of new beginnings. Yes, the impact or the benefit will trickle down into the following years. But at the same time, I think it's a very positive outlook for markets as well. On that note, thank you so much for your time, Manoj. And that's all for now. But to stay log on to etmarkets.com for more on news, business and economy. Again, thank you so much for your time.
Thank you, Kshitij. Appreciate your time. Thank you.